This short tutorial demonstrates how the cost of goods sold is calculated in the profit and loss statement. To demonstrate this, take an example of a simple shop selling one product. If the shop opens for business on January 1st, the owners purchase 1,000 units of product from a supplier for $2 per unit. In the month of January, the shop sells 800 units of product for $10 each. What profit does the shop report for the month of January? Firstly, let's look at the P&L. The items are deemed sold once the risks and rewards of ownership transfer to the buyer. When the risks are deemed to be transferred to the buyer, revenue is measured at the fair value of goods sold. In this case, the fair value of the goods sold is calculated from the quantity of goods multiplied by the selling price. Hence, the revenue is $8,000. We must now calculate the cost of goods sold. The matching principle dictates that we match the revenue with the cost of earning the revenue. Therefore, even though the shop has purchased 1,000 units of the goods, the fact that only 800 units have been sold means that we match the revenue earned with the cost of 800 units. As each unit was purchased for $2, the total cost of goods sold is $1,600. That gives us a profit of $6,400. Now, since we match the cost of only 800 of the 1,000 units purchased, we must also account for the remaining 200 units that are left at the end of the accounting period. These 200 units are remaining in closing stock of the shop at the end of the accounting period. Therefore, these 200 items are assets of the business at the end of the accounting period. Assets are recognized on the balance sheet. Assets are measured at the lower of cost and net selling price. In our example, the cost is $2 and the net selling price is $10. Thus, the lower of cost and net selling price is $2. Thus, the 200 units of closing inventory is valued at $400. Let's update scenario 1 with the assumptions that customers do not pay for goods until 60 days after sale, and the suppliers are not paid for goods for 90 days after purchase days. In this revised scenario 2, what profit does the shop report for January? Once again, in scenario 2, the principle is that revenue is recognized only when the risks and rewards of ownership are transferred to the customer. So once again, in scenario 2, the revenue is measured at $8,000. So even though the customers have not yet paid for the goods, the company recognizes the revenue. This is because the risks and rewards of ownership of the goods have been transferred to the customer. To present a true and fair view of the performance of the company, we match the cost of goods sold with the revenue earned from selling the goods. Even though the company has yet to pay the supplier for the goods, the matching principle dictates that the cost of goods sold is recognized immediately in the profit and loss. The financial statements would not be true and fair if we did not recognize the cost of goods sold. Hence, identical to scenario 1, the profit in scenario 2 is also $6,400. This profit is earned even though the customers have not yet paid the company and the company has not yet paid the suppliers. Thus, we can say that the profit and loss statement has nothing to do with cash. The profit and loss statement is not prepared on the cash basis. The profit and loss statement is prepared on the accruals or matching basis. Now let's look at how the balance sheet is prepared for scenario 2. Once again, the closing 200 units of inventory are measured at the lower of cost and net selling price. This is $2. Thus, exactly as scenario 1, closing inventory is measured at $400. But now, different to scenario 1, we must also recognize that customers have not yet paid for the goods the company has sold to the customers. Customers who have not yet paid for the goods are called debtors. They can also be referred to as accounts receivable. As no customers have yet paid for the goods, the fair value of accounts receivable is $8,000. Similarly, we must also recognize that the company has not yet paid the supplier for the goods that the company has purchased from the suppliers. Suppliers who have not yet been paid for their goods are called creditors. They can also be referred to as accounts payable. As the company has not paid any supplier, the fair value of accounts payable is $2,000.